All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Going to go out this morning and take a look at the bank trade here with you as a few questions about it have come in over the last week, and we'll go look at that. But let's start with the challenge. There are no new triggers on the board here this morning. We do have some crossover action out there. Let me kind of show you what those look like here. On the downside, we have Caterpillar, J&J, Juniper, JP Morgan, AT&T, all with downside 3-7 crossovers. The only one that really has a chance of triggering later today is Johnson & Johnson, J&J here, and you can kind of see what that chart looks like right here. It's been mired in, a 4-month consolidation, a pretty hefty consolidation, and it's had, 1 or 2 day pop, 1 or 2 day drop, type of situations, but it does have the potential to signal bearish here this afternoon. So that's the only one with with the potential on the bearish side. The AT&Ts, the Caterpillars, they're coming off new highs. That's typically not what we see when a stock is ready to, go on some sort of significant downward move. On the upside, we have Dollar General, Barrick Gold, Procter and Gamble, Target, and Vulcan Materials. Here now, Target has earnings upcoming. And they're up today on Walmart earnings. Procter and Gamble, we talked about yesterday. This one could trigger today. I've been watching the options on it this morning. They're not very good, but we'll see how that plays out. Barrick Gold, no real chance of triggering. Dollar General, very good chance of triggering here this afternoon, but this is one that is on the tier 2 list of stocks, meaning what? Meaning the options typically are not very good. And if it signals and if those options are really good, then I'll go out and get into it. This morning, looking at the options, they're nothing great at all, but it's also not triggered here. So we'll see. It could trigger by this afternoon. And then Vulcan Materials, which isn't a trigger. But you can see, the stock finally had a pullback. It's getting a nice little bounce back here on it, but coming off of a new low here. So no trigger action there with Vulcan Materials. So that's kind of where things sit here. We do have the potential for Pepsi to trigger here by the close of the day, but it needs to rally. It still has that 3-day below the 7-day. Both are trading below that 20-day moving average, which isn't typically what I want to see, in terms of having high hopes of a challenge trigger to come in. Not that the 20-day moving average is in the algorithm, but the chart here, we've set it up so that visually you kind of get a clue of what it's going to look like. The most trades, what do they have? They have a Stoke 39.1 that's up here above 50, and they have a 3-day, 7-day moving average that's crossing over and then pushing above a 20-day moving average, from a visual standpoint. They don't all look like that, but they're pretty close there. But in all here today, market, very little movement in it here this morning. It's up 0.5 points. 0.05 points, excuse me. So 0.02%. It has been incredibly flat. And it has been incredibly flat during the month of November here. And, we haven't seen much change in the metrics. We kind of have this standoff right now between the U.S. and China that the market's watching. China wants the U.S. to drop tariffs as part of a Tier 1 trade agreement. The U.S. wants China to purchase agricultural products. And, it's the same arguments. It's the same, ideas and theories. It's the same speculations that have existed, and I would not be surprised if we wake up one morning to a market that's down 40, 50 points on some sort of trade war news. I don't think there's a risk of seeing the market up 40, 50 points on some positive trade war news, but 10, 12, 15 points is probably what it would be worth at this point. But the market is, the market's leaning a little more bullish than it has in quite some time, and one where we've gone out a few times and looked at this sentiment survey, the AAI sentiment survey here. And, you can see here that, bullish is now above the historical average. And we saw market hitting new highs, and, the bulls were down here really low, and the bears were really high. And it's like, okay, market's going to keep going up. But right now, we have a lot more people who are bullish than bearish in this market. And, this is what we tend to see it or tend to see at new highs, right? It's not what we saw at the breakout. In fact, on the breakout, we saw a lot more bears than bulls, but now we're looking at a lot more bulls than bears. And so what's that tell me? That tells me that the market isn't necessarily going to go down, but it tells me that it's ripe for some sort of hard, fast move to the downside. Even something like this in August or something like this here in September. But the bears are going to need a catalyst, right? They're going to need a catalyst, and there's several things that could ultimately trigger that catalyst. I did yesterday go out and buy some put spreads down here at the 300 level on the SPY. Just put what I was willing to risk, just in case the market decided to have one of those days. But that's, I'm very light in my personal trading right now, just simply because there's not enough movement out there to justify a lot of options. But I did have to go out and put that trade on. And, I have 3 weeks. We'll see kind of what happens in that time period. But, it's just one of those where we do see the bull bear balance, a little more aggressive on the bull side than it has been in quite some time. And this is, for me, this is a contrarian indicator in every way, shape, and form. It's not overly bullish though, and it's very much like the market vibe, where we're starting to see, even in the market vibe, we're starting to see some weak points come in, but not enough to say, hey, you know what, bears are in charge and off and rolling. Okay. All right, so gonna go or stay in cash here for the challenge, and we'll be waiting for the next signal. We have J&J that could trigger here by the close, and we have Pepsi, Procter and Gamble, both potential. Dollar General to the upside here, later on here today. Okay. Now, I want to go out and take a look here at the bank trade. I'm going to look at Bank of America and J.P. Morgan specifically here with you. And the question comes with the banks is, well, they've had a nice run. Are they still buyable, right? And here's a weekly chart of Bank of America, and you can see a 2-year consolidation, right? Nice little 2-year consolidation and breaking out of that consolidation, right? Not unusual. Right here it went through a 1-year consolidation back here in 2016, 2017, and it broke on out. And it was about a 6-month rise where the stock, went to a new level, basically. And now we have a longer consolidation. We have a beautiful breakout on all the right things. And so can it go higher? Is it justified to go higher here? Same with J.P. Morgan, right? J.P. Morgan, very similar. Had the consolidation near that same time as Bank of America. Nice run. And then multi-year consolidation and in breakout mode, right? Both of these stocks, Bank of America, J.P. Morgan, are on the challenge watch list, have not been able to play this breakout because we've not seen signals come in. We haven't had that fresh 3-7 crossover except for on earnings. And I would like to play them, but they need some sort of pullback for that to happen. But fundamentally, are they justified to keep on going up? Yeah, you betcha. And let me show you why. And I do think these are very nice investment opportunities after a pullback. I'd let them pull back, and you heard me say it a couple weeks ago. I'm not interested in buying Bank of America, J.P. Morgan aggressively until they get a pullback, some sort of pullback, and they're starting to have one, but it's not really much yet, but do want to see some sort of pullback. But fundamentally, right? Fundamentally, let's go out and take a look at a few things here with them. Let's start with J.P. Morgan, right? And here's the price of the stock over the last 10 years. And it's gone from 30 up to 130, right? I mean, that's a monster move. 30 to 130 here for J.P. Morgan, right? Well, take a look at the dividend on it. The dividend for JP Morgan has been pretty consistent the entire time. Most of the time with stocks, we see an AT&T type situation where when the stock goes up, our blue line here, stock goes up, our dividend goes down, right? The dividend yield, right? The amount of dividend per dollar spent on the stock, and we see this scenario playing out. Stock go up here in 2016, dividend yield go down. Then when the stock falls, the dividend yield goes up, right? And a lot of times what we will see is that a stock will top when the dividend yield bottoms or finds some sort of resistance or support area, right? And it's one of those that we're not seeing in the banks. We're not seeing that dividend yield issue with the banks. Why? Well, because they're a little bit beholden to the Fed in terms of what they can do. And so as they get stronger, as the earnings build, as their reserves build, we have seen the Fed allow the banks to raise their dividend. And so they've been able to keep the dividend up there, increasing the overall payouts. Even with the stock price on the rise. And both Bank of America and JP Morgan have been able to do this. Here's Bank of America. It's almost a 2% dividend now. And when the stock was down here in single digits, the dividend yield was less than 1%. So, this has been a big change here for these banks in a very unusual situation that we don't see with most stocks, where the dividend yield continues to rise even with the stocks rising. And if you look at what's going on out there, it's still set to continue in the years to come. The Fed will still, as the banks strengthen, they will continue to allow them to increase their dividend yield. So it's not something that you go, well, you know what, maybe the dividend yield is a little out of whack, out of balance. No, all the forces that have created this action of dividend yield going up with stock price are still in play, which is a very bullish thing here for them. What about their revenues? Well, here's JP Morgan revenues, right? I mean, they just keep on climbing. They just keep on climbing in a very nice way, very consistent way. Here's Bank of America revenues, same thing. Not as flashy as J.P. Morgan's, but continuing to grow. You say, well, are they overvalued? Price to book value? Well, yeah. Bank of America is only trading at 1.2 times book. They're still very cheap on a historical basis, and you look at JP Morgan, 1.7 times book. They're still very cheap on a historical basis with price to book value. Okay, are they stacking in some earnings? Well, yeah. I mean, here we go with JP Morgan. They've gone from $6.40 a share here at the beginning of 2018 to up over $10 a share in earnings. I mean, they're absolutely earnings machines right now. Bank of America, same thing, right? They're just piling in the earnings. This isn't something where, you go, well, yeah, the revenues are growing, but, is it going to hit the bottom line? Yeah, their top lines, their bottom lines, they're growing like crazy. And then what else is growing like crazy? Take a look at their stock buybacks. I mean, look at the increase in stock buybacks. And I know it's popular on TV to say, well, stocks are only up because the corporations are buying their own shares. And we've heard that argument for many years now. And it's the worst bearish argument that's ever existed. And it's one where, yes, we continue to see them buy their shares, and it continues to put upside pressure on the stock. It continues to make their overall numbers look good, and you have the best of both worlds for the bulls when you're talking about stock buybacks. Now, if the buybacks were something a little bit different, where money was a little where basically they're saying, look, our business stinks, the only way we can grow it is by a buyback, then yeah, there's an issue there. But the stock buyback has nothing to do with the business slowing down. In fact, the business is increasing for both Bank of America and JP Morgan. And so their stock buybacks, I mean, look at JP Morgan's. Their stock buyback, just growing tremendously. And, they're on record of saying, look, they'll buy back more as the Fed allows them. And so you have a huge buyer in these names, right? Who's one of the biggest buyers of Bank of America? Yeah, Bank of America. Who's one of the biggest buyers of JP Morgan? You got it, JP Morgan. And so, to see these stocks go not only higher, but significantly higher, right? To see Bank of America go to $50 here a year and a half from now, that's not that much of a stretch. JP Morgan to 220, that's not that much of a stretch when you look at it fundamentally, right? Yes, if there's a big bad recession or if, a nuclear bomb is set off or an asteroid hits the earth, that's not going to happen, right? Those types of things, then it's not going to happen. But, when you look at these stocks from just a pure fundamental standpoint, they're in a very bullish position. Now, if you look at them from a technical standpoint, they have very nice weekly breakouts going on. Okay, and so we have these beautiful weekly charts, but the daily charts are very overextended, starting to pull back below the 7-day moving average. They need a little bit of a breather and a little bit of a break, and this is probably going to be something that may last 3, 4, 5 weeks in terms of a break. So I'm not really interested in being a buyer of them right here, but as we get into the new year. It is something that I think is going to be an incredible value for investors for the year of 2020. All right. Thanks for hopping on. Have yourselves a fantastic day. I'll be back on with you here this afternoon. I will talk to you then. Take care.